welcome everyone to our webinar, How Carbon Removals Can Be Part of Your Strategy. I'm just going to start with some basic housekeeping matters. So this webinar is going to run from 3 until 4 p.m. UK time. We'll have a guest presentation from our speaker, and I'll follow up that presentation with some questions to get the ball rolling of a discussion. You, the audience, are very welcome to propose further questions in the Q&A box that you'll see on your screen somewhere. Those questions will be curated to keep them on topic, and we'll answer as many of them as possible until we run out of time. And when you joined the session, you should have had a poll to asking you a simple question about removals. We'll display those results at the end of the session, so that we can all join in a discussion of those results. In fact, it just popped up on my screen, so I'm going to answer the questions a little later on. Now, so a little bit about who I am, for those of you who don't know me already. And I have a fair bit of background in carbon markets, but I run both Net Zero Markets and Redshaw Advisors. At Redshaw Advisors, we help companies to understand and transact in environmental markets. But today I've got my Net Zero Markets hat on. At Net Zero Markets, the hosts of today's webinar, we develop with our exchange partners products that are designed to smooth the operation of carbon markets. And our flagship product is the GER, that's the Global Emission Reduction. And we've constructed a hybrid offset that combines VERs from the 3 major categories that make up the VCM, and adds in a small but increasing proportion of long-lived carbon removals. In the GER team, and the team at Net Zero Markets have the twin objectives of standardizing carbon offsetting to make it more accessible and more honest, and facilitating a marketplace for removals. If you've got a reliable price for removals, then that can spur investment in scaling up what is a crucial, and I'll absolutely emphasize, a crucial segment of the market. And having a reliable price leads to financiers being willing to lend money to projects, and for project developers to take risk. The title of today's webinar suggests at least a couple of things. How carbon removals can be part of your offsetting strategy is the obvious one, but also how they might form part of an investment strategy. So I'm delighted to introduce Richard Barker, who will give us a thorough education on both of these topics as part of his presentation. Now, I'm going to introduce Richard. He's got about as good a CV as anyone can have for this space. Educated at Oxford University, he's got a Master of Engineering in Engineering, Economics and Management. He was previously head of strategy for ANZ, an Australian investment bank. He's been the CEO of Biogen. They're the UK's leading builder and operator of renewable energy projects that convert food waste to energy. And he's been the CEO of Recovco Affinet. They got spun out of Alcan. They're a specialist aluminium recycler. So today, as well as advising private equity investors on issues related to sustainable investment, Richard is now a partner at Counteract. They're a specialist venture capital firm. They're exclusively focused on early stage carbon capture businesses. And frankly, there's no better person I can think of to educate us all on the economics and opportunity presented by the business of carbon removals. And I think that's not least because he's deploying capital into this space, and in some cases they're already making a return on that capital. So without further ado, Richard, over to you.
Thanks very much. Hope everyone can see that screen. Thank you, everybody. Thank you for your introduction, Lewis. Apologies for the little technical problem there. So today I'd like to talk to you about carbon removals and how that can be part of your strategy, and I'll come at it from a number of angles, but hopefully it should cover what you're interested in and cover quite a lot of areas as well. Sorry. So first of all, I'd just like to take a minute to talk to you about Counteract and what we do. And then I'm going to start from the very beginning, which is what is carbon dioxide removal. I think it's important to get the definitions right because it is an evolving area and quite a new area, and just aware that it's important we delineate it from emissions reductions and other things. Really want to talk also about why carbon dioxide removal is essential to tackling climate change if we want to maintain the global warming problem within manageable levels. And then where does it actually fit within a net zero strategy between now and, let's say, 2050? And then talk about the status of the CDR market. And I think you'll find out it is incredibly early as a marketplace, but it is moving very, very quickly. So I'll just crack on. So a little bit about Counteract. We set ourselves up with the mission to catalyze 5 gigatons, which is 5 billion tons of carbon dioxide removal by 2050. And as a team, we've been investing in this space since 2020. We were actually the first dedicated carbon dioxide removal investment team globally. And we're focusing at the very earliest stage, so pre-seed and seed stage investments into companies which are looking at carbon removals. And we obviously invest in those companies, but we're all kind of seasoned entrepreneurs and builders of businesses in the past. So we think part of helping this ecosystem develop will be bringing strategic advice and our own experience of growing businesses at pace and at scale. Our first external fund is Counteract 1, which is a 35 million Article 9 SFDR fund, and we hit first close of that back in December 2022. And we've kind of put in our existing investments into that vehicle alongside new monies from new investors. And we welcome discussions at all times with new financial and strategic partners in terms of understanding the market, in terms of looking at investment opportunities, in terms of what the fund may be able to do in terms of catalyzing this marketplace. So let's start at the very beginning. What is carbon dioxide removals? It is defined as anthropogenic activities removing carbon dioxide, and we would call it's not just CO2, it's things like methane and other greenhouse gases, but the reality is the majority of the focus is on CO2, and it's from the atmosphere and then durably, i.e. for a long period of time, not just for a short period of time, in geological, terrestrial or ocean reservoirs, or indeed in products. And really that is the critical definition of it. So when I first started looking at this area, and when I talk to people about it in passing, if I, meet them over dinner or something, they tend to say, what, carbon dioxide removal, it's just planting trees, isn't it? And of course, that isn't actually all it is. So what I've tried to do is characterize CDR or carbon dioxide removal in kind of 6 major buckets. Now, it's not as simple as this, but hopefully this will help kind of outline the kind of things that we look at and the kind of pathways for removing carbon dioxide that are going to start evolving in the coming years. And the first one is oceans. And if you look at carbon dioxide as a gas, surprisingly, 93% of CO2 is in solution within seawater. So even though you look above you and look in the atmosphere, you might think it's all about CO2 in the air. The reality is CO2 is continually cycling in and out of solution in the ocean. And therefore, by finding techniques to increase the ocean's ability to absorb CO2, you can dramatically change the level of greenhouse gases and carbon dioxide within the atmosphere. And those are things like alkalinization, so putting particular minerals in the ocean that change the alkalinity, which therefore changes the level of carbonation and absorption of CO2. Things like fertilization of macroalgae, so seaweeds or microalgae, for example, and seeing if they can absorb through photosynthesis more CO2. And there's a range of other technical things that deal with the ocean's carbon cycle. Then we have the traditional area around forestry, so reforestation or afforestation, soil, which is an adjunct to that. So if we look at agricultural practices, there are ways of looking at the level of carbon that is absorbed within soil. And you might have heard of terms such as regenerative agriculture. And there's been a lot of recent work on fungal and microbial innovations that help accelerate the absorption rate of carbon dioxide and carbon materials within soil structures. Then we have biomass, which you've probably heard of, BECCS, and then biochar, but it's to do with anything that you grow as a biomass and what you do with it. And it could be in terms of creating energy, burying it, or doing something to trap the carbon that the trees or the other biomass have absorbed through photosynthesis from the atmosphere. Then we have direct air capture. So there's actually the sucking in of air, separation of carbon dioxide, and then pumping that carbon dioxide usually into some kind of underground reservoir where it can be stored for the long term. And that's potentially thousands of years. And there are a number of technology solutions that sit in with that and a number of business models that are applicable to that. And then finally, there's something we call rocks. This is a broad church, but it's the idea that rocks over geological timescales absorb CO2 and carbonate. So they change the form and they absorb CO2. And there's a lot of work at looking at, is there a way that we can help rocks accelerate their carbonation and absorption of CO2? So that hopefully gives you an overview. Now, as in most things, it's not actually as simple as those 6 discrete areas. And if you tried to make it more complicated, I could go deeper and deeper. But the only thing I want to say about this complex space is on the top right-hand side, is that the most important thing to think about is, what is the time scale of your carbon dioxide storage or carbon storage? And if you're in biological time scales, so annual cropping, for example, agriculture, that tends to be in a yearly or a decade cycle, through to other materials that can last for decades to hundreds of years, and others that can last thousands of years, usually through minerals and so forth. And what we can see is understanding the dynamic of durability, together with the way a lot of these different technologies or solution pathways interact with each other and interact with the larger economy. So the impact of using agricultural space for forestry, for example, is critical to understanding the sustainable and ecologically aware and environmentally aware deployment of these kind of technologies. So what is not CDR? It is not emissions reduction, which is probably, a larger big brother of what we do. Now, we would say emissions reduction is absolutely important and is critical to a net zero transition, but it is not carbon dioxide removal, it's emissions reduction. It is also not point source capture from, let's say, a gas-fired power station or a cement works. That again would sit under emissions reduction. But it would be BECCS or BICAs. So using biomass and some kind of carbon capture or carbon removal technique to then take that biogenic CO2 out of the air and lock it away. So why is CDR essential to tackling climate change? Well, if we look at the IPCC reports and future predictions about the level of emissions, we currently sit at around 50 gigatons a year of emissions. And depending how optimistic or otherwise you are on our ability to decarbonize, you will be left with a rump amount to actually remove on an annual basis from the atmosphere. And estimates put that between 5 gigatons and 15 gigatons a year of CO2. If we're not good at reducing our emissions and we still want to have a hope of hitting a 2-degree rise or a 1.5-degree rise, that number could rise considerably above 20 gigatons a year. So this is a big challenge, but the reality is in all of the IPCC future predictions, carbon dioxide removal is an essential part of these future pathways. And indeed, it is put into the future projections at a minimum of 10 gigatons. Now, I was chatting with Lewis the other day, and because I'm sadly technical and a little bit of a nerd, I tried to characterize how big is 10 billion tons of CO2. So I thought this might just be useful because we have to understand the scale of the challenge we have here and also the scale of the kind of solutions we need to bring to bear. And I suppose the first comment here is 50% of all air in the atmosphere resides below 5.6 kilometers. So that's way below the height of Everest. And that just goes to show you that actually most of the atmosphere that we think about and the CO2 that is trapped only happens a few miles above our heads. It doesn't, it's not into the kind of infinite sense of space. Now, taking a few shorthand calculations, If we were to have 10 billion tons of CO2, that would fill a balloon roughly 22 kilometers in diameter. And just to give you a sense, obviously that is, way above where commercial jets fly. It's sitting up right to the top end of where humans can fly today. Now, if you were to take air that had 400 parts per million of CO2, which is atmospheric CO2, that balloon would suddenly be about 150 kilometers in diameter, which is roughly the lower end of low space orbit. And so just gives you a sense of this is not a trivial problem in the sense of getting this level of CO2 out of the atmosphere. And again, to give you one little fact, which is probably the only fact you'll remember from today, is that if you were to use a Dyson hairdryer to try and fill that balloon, that would take you 32 billion years to fill that balloon, which is twice the age of the universe. So we're talking about huge movements of gas, of air, and a huge challenge in terms of converting that or sequestering it. And this is a per year figure. So we will be having to do this every year by the time we hit 2050 if we want a chance of kind of hitting those climate targets that we've talked about. So in order to address that huge problem, that enormous balloon, how can we do it given those different kind of techniques or CDR pathways that we've talked about? Now, I purposely created the most confusing graph because actually this is a very confusing space. And the one thing I particularly like, it's got a logarithmic scale, which is hugely difficult to get your heads around in the best of time. But when you put it on a spider graph, it's almost unintelligible. But the very simple point of this is that if you look at all of the low estimates that the scientists give us, no single one of these pathways can get us to 10 gigatons a year. And at the high estimate of the potential for these, there are only two, which are ocean alkalinity enhancement, which is changing the alkalinity of the oceans by putting minerals in, or direct air capture. But even with those two, the challenge we have is direct air capture is to just remove a gigaton of carbon dioxide from the atmosphere today would require all of the world's renewable energy capacity at today's current level of efficiency. So clearly that just is a non-starter in terms of our technical understanding today. And similarly, from ocean alkalinity enhancement perspective, we have a real challenge that the science around this is so early stage that we don't know the unintended consequences of changing alkalinities in oceans or fertilization, I think, because we have a very delicate ecosystem. And the one thing I know is if 93% of the CO2 sits in the oceans, if we get this wrong and get a 1% shift the wrong way, we get 17% more CO2 in the atmosphere. So we need to tread with caution in all of these areas. But the truism, which is what the UN chief Antonio Guterres said, was our world needs climate action on all fronts. And with CDR, it's got to be everything, everywhere, and all at once. So where are we on this journey to hitting that 10 gigaton figure? I tried to do a little kind of image here to show where we are today. If you count each one of the dots in the graph there at about a million tons, we are nowhere, is the reality. But if we try and get to the kind of 10 gigaton scale we're talking about, this will become around a $1.4 trillion industry per year by 2050. And on a comparable basis, that's roughly the size of the global chemical industry today. So we are moving from a standing start to a very, very considerable market and part of the new economy within about 30 years. So where would CDR fit in a net zero strategy? Well, the reality is if you have a net zero strategy, you must by definition be planning to include CDR at some point. Because once you have decarbonized or moved to renewable electricity, there will always be things within your direct control or in your supply chain that is producing carbon at some level. So in order to go to net zero, you need to be thinking about carbon dioxide removals to offset those particular emissions. And in fact, if we do what we think we're doing, the market will only be CDR by 2050 because we should have taken out all of the emissions that we can do. And this will be the rump offset of those things that we can't be reducing. And that's quite an important point in terms of long-term corporate strategy, because this is if you were building a large steel plant or something else, you are looking at a 25-year investment cycle, and we are in 25-year investment cycle territory already here. And so how should you think about CDR? This is a curve that I know Goldman Sachs have done one, McKinsey have done one, and it's called the MAC curve, or the abatement cost curve for carbon. And what this is showing is that there are things that don't cost much to take CO2 emissions down. And an example of that would be, for example, installing LED lights, where it's actually a negative cost to do that. It gives you an immediate payback in terms of doing that. And there are those things which are much more expensive and can cost you around $1,000 a ton, for example, of CO2 if you want to decarbonize current technologies. And where we believe the kind of market is, which funnily enough is roughly where the kind of EU ETS is trading, is if we can find CDR pathways that get us to around $100 a ton in long-term costs to remove and sequester carbon, that gets us in this long kind of saddleback here, if you like, and suddenly becomes a very, very large and compelling market opportunity. So how has the CDR market developed over time? Well, I think it's fair to say there is a fair chunk of forestry-related CDR, carbon dioxide removal, that sits around today, and that tends to sit on the side of commercial forestry activities where they're looking to plant trees, claim some kind of CDR removals. However, if we put that to one side, now the reality is only according to, and these is data from less than a month ago from CDR.FYI, we've got less than 750,000 tons of CO2 has been purchased. And of that, only 9% has actually been delivered. So a lot of these are forward contracts that corporates have purchased. And as you can see from that little kind of bar chart, we have got absolutely nowhere towards that kind of 10 gigaton figure. Now, what we can also see is that the market has only really kicked off through last year, 2021, and that those deliveries, again, are only starting to tick up from that time. That really is because if 2 years ago when we started investing, this market did not exist. So it really is a very, very new market. So who's buying and selling these offsets? The main sellers, as you can see here, all sit within the biochar or bio-oil space. So what they're doing is they're taking biomass, usually wood. They are then pyrolyzing it, turning it into some form of char or charcoal. And then they are attaching to that CDR offsets and using that biochar in some kind of durable application whereby they can account for the fact they're trapping some of that CO2 in the form of biochar. So you can see we're at very, very low tonnages here, especially when you compare it to the emissions reduction tonnages that are out there. Who's buying these? Well, notably, Airbus came into the market to buy 400,000 tons recently. But if you put Airbus to one side, we're dealing with some of the familiar names, Shopify, Swiss Re, Microsoft, Stripe, Klarna, who are really progressive corporates putting toe in the water. This is almost semi-philanthropic or seeding a market to say, we want to start to see and help bring this market together. So it really is at its infancy, but it's got a huge potential future opportunity. Now, where do people buy CDR certificates or offsets? And when you look at the kind of marketplace, there are a number of intermediaries or markets or registries who are selling on behalf of producers and selling those to corporate or other end users. And that's dominated by Carbon Future, Puro, and Supercritical. But quite quickly, you can see if you go outside these kind of top 10 or 11 players, you're into very, very small tonnages indeed. And I suppose one of the things we notice as an investor in this space is we probably get on a weekly basis inquiries or requests for investment into some kind of carbon removals platform, be it a trading platform, some crypto-based platform or otherwise, whereas the number of projects that are feeding these platforms are actually less than the number of platforms that exist, which tells us there is something wrong with this marketplace and that we need to to really start driving the supply, driving the people who are developing the technologies. So where does that leave us? How should a company think about CDR? Well, I guess the first point is, if you have a net zero target, you will need to be planning for some CDR at some point. And as a result, you really should be part of your thinking today. So if you're thinking in 5-10-year investment cycles, you need to be thinking about where CDR sits within that. Hopefully, as you've got a sense, it is an incredibly early stage of development. And it is actually, in the meaningful sense, less than about 2 years old. And in order to develop, it needs support really across the supply chain. So entrepreneurs who are coming up with new technologies or more efficient approaches to separation and sequestration of CO2, investors like ourselves who are willing to put capital up to start priming this area, purchasers who are willing to put their toes in early and get engaged with this market, and governments to set the kind of guardrails and rules for how this is going to develop over time. Now, I think what is clear is when you have an emergent market like this and you have a very rapidly developing requirement, there is going to be, and we're already seeing it, frankly, a mismatch in the supply of carbon removals between supply and demand. And that means from an investment perspective, that's a key risk management issue. And if you need to secure early supply or confirmed longer term supply, you need to be thinking about the supply and demand risk of not actually being engaged early enough, because there may well be a dramatic undersupply, in which case, whatever price you think, you may struggle to get it. So that's it. Thank you very much indeed. I hope that wasn't too technical. And gave you kind of a whistle-stop tour of where it is.
That's fantastic. Thanks for that great presentation, Richard. Super informative. The Dyson hair drying analogy will stick, but unfortunately, as will the thought that the market is so nascent and so very small at this stage, and how important it is. We asked everyone some questions when they joined the webinar. And I think they've been displayed for everybody. So just looking at the first question, do carbon dioxide removals currently sit within your net zero strategy? And I suppose nothing particularly surprising there, Richard. My thoughts were that if people say no, why might that be? Any thoughts from you?
Yeah, well, I think it's a good question. And, when we look at it from our side and we engage with, project developers, technology developers, as well as corporates sitting on the other side, I think, the first thing is there is no availability today, as we saw from that graph. We're in the thousands of tons. There is absolutely a lack of knowledge about the different pathways, what it means, how we think about durability, those issues. There is absolutely fear, and some of that has been driven out of some of the articles that we've seen in The Guardian about emissions reduction and questionable kind of MRV around forestry. So I think that spills over to this area. Clearly, because this sits within the voluntary market, it's early stage. And in a way, if you do something and you are found to be doing the wrong thing, you probably have a worse result than if you've not done anything before at this very early stage. Price. These clearly are more expensive than a lot of the kind of red or other offsets that may be available, and that's the nature of the business. It's the nature of what we're doing. And then finally, frankly, standards and verification. Look, we're very early in this pathway, and the science, the measurement, the approaches are all coming together and are being developed at the same time. And so I think we need to bottom out some of that MRV consideration before the market says, yeah, it's credible, it's trusted, and we're willing to move.
Very good. And the second question is, has your company purchased carbon dioxide removals to date? And perhaps the unsurprising answer is that most haven't. Well, actually not most, it's just slightly under half. We've got a mixture of people saying yes and those that are looking into it. I suppose the surprise is the number of people that said yes.
Well, maybe we've got a select group.
Yes, they're self-selecting.
We've either got a very select group, or we have a group that maybe doesn't understand the difference between CDR and emissions reduction offsets.
And and possibly, well, we'll get to this question later actually on forestry versus other things. So then we've got when does your company anticipate purchasing carbon dioxide removals? And a minority saying never, and the majority looking to do something within the next year. And
that's really interesting to me. You know, if we look at the previous question, around those who have purchased is 24%. So if we're moving from 24% to date to 40%, that's quite a dramatic increase. You know, that's a 50% increase in market participation, you know, from 12% up. So that's interesting to me.
Yeah, and it's clearly a hot topic. And then the question then is what type of offset? So we'll get to that in a moment. So that's the fifth question. So the question 4 was, what proportion of your current emissions are likely to be offset by carbon dioxide removals this year? And I think the surprise there is more than 80%. There were 24 people answered this question. 3 of them said more than 80%. That's just fantastic. Where do you think they're getting them from? Or is it just Airbus and the handful of companies we had on our list?
Well, I'd imagine Airbus has maybe more than 400,000 tons of emissions. But anyway, that's a really interesting question. Now, I wonder, is that deliverable in the year? You know, or is that is that a forward delivery, a current delivery? I'll be interested to see how that you know, plays into current emissions versus future emissions.
Yeah, and supply is very much stacked in the future, isn't it? And then the last one on the poll is which type of carbon dioxide removals would you be most likely to purchase? And no surprise for me is the forestry-based one, because it's the cheapest, and the others presumably because they're just less developed and less available. What do you think?
I think that's right. I think it's an availability and price issue, and it also may be, again, a definitional issue. You know, of those forestry-based, are they really CDR or are they emissions avoidance style? You know, again, you know, how do people? We can be very loose with the terminology, should we put it? And so, just understanding really what that is important, I think.
And that creates an interesting question to you as an investor. If you were well, you are investing in CDR related projects, so would you consider forestry in your portfolio in some way?
We set ourselves, as I said earlier, the objective of being catalytic in this space, and we are, you know, we're a venture capital investor, so we have not set ourselves up as a, should we say, an infrastructure or real estate investor who can buy tracts of land and think about forestry as an asset class. What we do see is that in order for forestry as a pathway to develop for CDR, we need to get much better at measurement and verification. So where we tend to invest is in new technologies around doing a better job of measuring. So we've invested in for example, a business which is looking at satellite imagery together with ground truth data and a mix of other data inputs to try and do a much better job to verify and confirm the level of biomass within a particular forestry project, for example. And it's those kind of things that will improve trust within the marketplace and hence hopefully investment, liquidity, all those other things.
No, very good. One of the features of your presentation was that marginal abasement cost curve and that plateau at around $100, €100. Now, like you say, there's some companies that are happy to spend quite a lot of money on a relatively small amount of carbon, but ultimately it's a small amount of carbon, not anywhere near their total footprints. Does the CDR market, is it going to rely on legislation and compliance style markets, or do you see a future for CDR in the voluntary space?
Look, I think I'm going to answer this in two ways. On one side, as a really early stage investor, we are, and this isn't true, but I'm trying to, you know, create the point, is that we are kind of agnostic about how these different pathways or every ton of carbon dioxide removed can be monetized. On one side, you know, it could be monetized as a compulsory offset, if you like. On the other side, it could sit within a voluntary carbon market as a particular offset. And indeed, our thesis would be at some point, those two markets are going to have to talk to each other. There has to be some kind of commonality of pricing and definition and so forth, but it's not there yet. On the other side, we're seeing a real trend around insetting. So corporates looking along their supply chain and saying, look, how do we drive down our scope 3 emissions in our supply chain? And what are we willing to pay in order to do that? Now, if you are someone, if you're, let's say, a farmer supplying a supermarket today, if you're creating carbon offsets from regenerating your agricultural approach, do you monetize that by selling those to third parties, or do you embed that in your own carbon footprint and sell that to your supermarket at a price? Now, clearly, depending how those prices mix will determine where that is. And then finally, where does carbon tax play a role, and kind of carbon border correction taxes? And we're already beginning to see that talked about. So I think on one side, we would be agnostic about that. But what we believe is there has to be a price for CDR that is upwards or around about of $100 a ton in order to make some of these technology pathways work effectively and in a way that is not open to, some of the reputational issues that may be out there. Now, I think on the other side, look, relying upon voluntary action here only, I think will become an increasing challenge, because quite clearly, we're dealing with the, if you like, producer pays issue around pollution, and you're dealing with some questions around, is it more sensible to try and reduce your own emissions, or is it more sensible to offset in the short term? And and I would hate to think that greenwashing, so corporates are using it as a greenwashing thing, but I think there has to be some way of connecting the markets and being efficient in your transaction and your transition between carbon reduction and carbon removal. But hopefully corporates are taking the reduction piece seriously, and I think corporates have to show real intent there before they're let loose on the carbon removals market, if you like.
Yes, I'd have thought, so with compliance markets heading to net zero, so Europe's enshrined into law, it'll hit net zero by 2050. The UK's done the same, and a number of other countries have done the same thing. You made the point earlier in that answer that voluntary and compliance markets will merge, and in your presentation in 2050 they must merge, because if you're hitting net zero, you can't have avoidance anymore. You can only have removals. So I'm interested to know more about the kinds of investors you've got in the fund, because on the one hand, anyone involved in the EU ETS that's forward thinking enough will predict that they're going to face a pretty high cost of carbon in the EU if the EU is going to stick to its legally binding net zero target. And as you've said in your presentation, ought to be thinking about this today, purely from a compliance perspective. And then, of course, you've got other companies that want to help to try and spur the market on, and other companies that want to include CDR in their offsetting activities. So, what kind of investors do you have in the fund?
Well, interesting question. Look, when we started this, we thought this would be in the domain of foundations, ultra high net worths, those who are interested in having impact. What we found quite quickly is there was significant corporate interest in this space. And I think part of that is corporates who are maybe at the front of this are saying, well, look, by investing in early stage funds such as ours, we are getting a window into the way the technology is developing and the way the marketplace is developing. And so, the only one I can talk about that is public is Anglo American. So they came in on our first close, and clearly, they're a progressive company. Clearly, they have very significant carbon footprint as a kind of diversified international mining operation. But they're very clear that they have a role to play in this as well. And you can see from one of those market areas under mineralization, they're a company that's used to moving, millions of tons of material around. And therefore, understanding how this whole marketplace is developing is not only a strategic carbon imperative, but it is a strategic opportunity for them. And so I think we're getting investors in our fund who are corporates who are beginning to see there's not only a requirement to do this in terms of managing their carbon exposure risk, but also a potential strategic opportunity from what they're doing. And I think, you know, to be clear, when people invest in our fund, they are not buying carbon offsets. You know, we don't, you know, not for every dollar they put in, they're not getting carbon offsets or future carbon offsets. They're investing in the fundamental technologies around that. Now, the companies themselves that we invest in may at some point be producing and selling those, but they will be sold on a, you know, commercial basis or in the future. Now, you know, our expectation is that, you know, should we be successful in the coming years, you know, we may look to establish some kind of project infrastructure real estate fund, which is looking just at CDR. Now, that would be considerably larger. It would be structured to take investors' money in, and the offtake would be some kind of carbon removal certificate or carbon removal right. Now, that becomes directly linked then to money invested and the ability to take those or monetize that as an opportunity. Yep.
Oh, very good. Thanks. One of the talking from a Redshaw advisor's point of view now, we get more phone calls from people looking to deploy capital than we get from CDR projects looking to obtain capital. As part of our day-to-day business, we're trying to connect those. How difficult or how easy have you found it to be to deploy the capital that you've raised?
Look, I think we're in a very fortunate place. The reality is we're overrun with opportunities. I think, as I said earlier on, we see far too many kind of crypto or Bitcoin or, you know, blockchain related deals. But, you know, to be serious, I think what has happened in the last few years, this marketplace has suddenly switched on in the sense that the number of universities, very technical entrepreneurs, or very, you know, people with very interesting business models are beginning to see that, you know, this is a $1.4 trillion plus market, which is going from a standing start today. That is driving interest from young entrepreneurs, from very technical, academic, you name it. So there is no shortage of, I think, investment opportunities. Our challenge is, and we take this very, very seriously, is not wanting to take investment down a cul-de-sac, and not, you know, and so we are hyper aware of the potential negative consequences. And I pointed that example in kind of ocean alkalinity projects of making sure that we are seen as a trusted advocate in this space, and are kind of very, very concerned about some of the hype we see and the bubbles and otherwise. So I suppose that's really, you know, central to how we view the pipeline. But the reality is we are beavering around dealing, you know, it's not as though we're twiddling our fingers wondering where the next deal's coming from. It's quite the opposite.
As a bit of an extension of that question, with your fantastic spider diagram in the presentation, what proportion of those project types would you say that you've managed to make investments in, or are seriously considering making investments in?
We have made investments in
one form or another, because including you talked about
one of those
stuff.
segments to date. Yes, we have made, or we're actually in due diligence on every single one of those segments at the moment, and that's part of our strategy. So we view, we have to be represented in all of those pathways, because all of those pathways will probably be needed in one form or another, and therefore it's a diversification play. And it is also important for us in terms of the catalyzing play to have a meaningful engagement in those pathways, so that we're developing knowledge, we're engaging with the right kind of networks to better understand those things.
Very good. No, thank you. So turning to some questions from our audience, I've got one here. Do you think Africa can be a major player in the CDR market? And when I saw that question, I'm preparing for a panel I'm moderating at Carbon Forward Asia, taking place in Singapore next week, and it's on the fast growing or potentially fast growing market in the UAE and in the Middle East in general. And it crossed my mind that, where there's plenty of sun, you can have some solar panels, and maybe there's nowhere for the electricity to go. You could do some direct air capture. That's the first thought that I had. What would you say about where Africa can find a role?
The answer to Africa is yes. And in fact, one of our kind of sub-investment drivers is, we call Global South. So we believe as part of this transition, we need to find ways to drive capital into markets such as Africa, because they will be the most affected by climate change. And so that is kind of part of the just transition play. I think from an African perspective, the thing Africa has is a huge amount of land banked. It has, as you say, great sunlight. And so we see there is, within those kind of afforestation plays, within some of the soil carbon plays, we see a very significant opportunity there to engage local communities in some very interesting projects. We also see an opportunity from bountiful renewable energy, from wind and solar, which will be intermittent, but there are certain solutions to CDR which are very resilient around intermittency. And therefore, that is kind of a match made in heaven. In fact, we just made an investment which closed in the last couple of weeks, where their first project is in the African Rift Valley, where they're looking to take CO2 and inject it into the Rift Valley into kind of a mineralization play. So it's different to the kind of, stick it into an oil well. This is an alternative way of sequestering it under the ground. And we like, because if you look at, Kenya, it is 95% renewable energy today. It has huge amounts of excess intermittent electricity. And the Rift Valley, because of the nature of the geology, would fit perfectly in that. So those are the kind of opportunities we see, and we're very, let's say we are looking to disproportionately weight over time in that area.
Next question. In your view, how important is SBTi endorsement of CDR? How important is it to the broader adoption of corporate adoption ambition of such solutions?
Look, I think generally, MRV verification, putting the rules around the expectations from various bodies is hugely important. In the same way that we've seen, the introduction of scope 1, 2, 3 emissions reporting, the kind of sustainability reporting and TCFD, I think they all have a role to play in terms of managing expectations and managing action. If it's measured, people can do something about it. So I think I would be broader than the question to say one of the things we're keen on doing kind of in our role is to work with governments, organizations, and otherwise in trying to get the right environment whereby the right kind of legislation, the right kind of measurement, the right kind of reporting starts to become second nature on this.
Another one if you're familiar with the Integrity Council for the Voluntary Carbon Market and the Voluntary Carbon Market Integrity Initiative,
yeah.
One setting or seeking to set standards on what should be allowed as an offset, and the other seeking to set standards on how offsetting and carbon neutral claims can and should be made.
Yeah.
Do you have any particular view on how the core carbon principles that the ICVCM have or VCMI's carbon neutral claims rules are set? Do you have any view on what contribution those two bodies could make to CDR?
Well, I think it's hugely important. I think, we have a number of, players who are intermediaries who are either trying to measure, set standards, or otherwise Vera, Puro, etc. And I think we need to cluster around common language, common benchmarks and understanding. So I think the kind of Integrity Council is a great focal point for that. And this is a journey, is the reality. And what we need to do is recognize, that as each of these new pathways open up, the research gets into place, the early measurement, the verification stuff, is we have to recognize we need to work together with those kind of agencies and players to come up with approaches that will drive those markets at pace.
Thank you. And this one's an easy question to answer, I think. But if a company wants to buy or sell carbon removals, which certification schemes are applicable today?
It depends what kind of carbon offset you're trying to buy, removals offset, so Puro, for example, and Vera, each of they have different standards for different types of CDR. So, and I know some of those are in the pipeline or in development. So, if you want for biochar, depending what kind, there will be standards that will sit, within those kind of, within those kind of agencies or standards companies. If you're in ocean carbon today, I don't know if there's a standard that's been kind of written today. I know there's stuff in the pipeline. So I think it's kind of, do you have an interest, or are you agnostic about which of these particular pathways? I know some corporates that have strong, so shipping companies, for example, they have a natural interest in blue carbon, in ocean carbon. Whereas if you're in the business of making, flat pack furniture, you probably have more of an interest in forestry related, because it sits within your kind of brand halo. So I think to answer that question depends upon your own particular interest in terms of the CDR pathway, and really how much you're trying to invest in the CDR itself, some of the byproducts, or I should say co-benefits, the other SDGs that may sit and wrap around that. So I think I can't answer that simply. It's a complex area, and this is kind of like trying to buy, over-the-counter derivatives versus, bespoke style.
That's not regulated yet, so
yeah.
you can advise on these things in the voluntary market. So expanding on that question just a little, then, so as far as I understand it, and Vera can correct me if I'm wrong, but the only carbon removal projects they've got outside of forestry are only methodologies they have for biochar. If I'm again, I'm happy to be corrected, but as far as I'm aware, Gold Standard doesn't have anything. Puro blazed a bit of a trail on this and has a number of methodologies. Why are there not more methodologies? What's holding back the standards bodies, do you think?
Well, I think it's resource, and there's not been around long. It takes a long time to put some of this, the methodologies together, because some of this is fundamental research, some of this is understanding how you undertake the measurement. So a lot of this is new, and I think the other thing is fair to say is there is, within some of the, these companies, they are picking off the different pathways as and when there is demand. So if there's sufficient number of biochar producers, they'll say, well, it's worth us setting a standard because we will start to see liquidity, we'll start to see payment related to that. Whereas if there's one company offering 10 tons of, ocean fertilization, they'll say, well, is it worth us trying to develop a standard today until we can see that market's really developing? So I think there is a little bit of a chicken and egg, but I know all of these companies are trying as quickly as they can to develop standards, but you can't do everything all at once.
Antonio Gutierrez says we need to.
We need to, but unfortunately,
it's not always that possible. That's right. And then I got another one here. Is will the CDR price be different depending on the source it's coming from? And the easy answer to that, unfortunately, I think, is yes. It may depend on permanence also. But Richard, should the price of a CDR differ?
Depends when. Today, yes. In the future, for me, I could imagine it may be asymptotic, right? There's an efficient market position here. And so, look, I think, as I was indicating before, I think different pathways will attract different buyers. So therefore, there'll be different buyer and seller profiles, and there'll be different pricing, and there'll be different reputational and brand issues that will go into that. So I think the answer is yes, to a degree, but ultimately, with my pure economics hat on, if we're trying to clear an efficient market and go for 10 gigatons, the way to do that is to go for the lowest cost, right? Over time, as that becomes self-evident or becomes clear or evolves over time. So I think, there is going to be something that should drive some kind of asymptotic outcome.
Actually, one of the thoughts I've just had is that different removals technologies have different CO2 residence times. Mm-hmm. So forestry being perhaps the most volatile, and then mineralization being the most long-lived and secure. And I think the standard that Vera have for biochar is 100 years plus. Carbon Future, I think, is the same. Do you have any particular view on where the standard should, the residence time should coalesce around? Is it 100 years plus?
I have a kind of a sense that there will be something called a carbon decade, which will become a unit. So I suspect the concept of permanency will be translated at some point into something like a carbon decade, or however we choose to frame it. Because I think
hopefully number of carbon decades.
Yeah, no, that's what I mean. But I think there has to be a sense of permanence, but also there has to be a critical recognition that there may be, at a market efficient price, semi-durable carbon removals that can happen over a 50-year time span, which gets us to a point, for example. So I think if we hang out too long for 1,000-year plus, I think, it's going to, do we let perfect get in the way of good? So I think that concept of semi-permanence, or a way of that we value a carbon decade, is going to have to come into this kind of valuation model at some point.
Or if it's underwritten by governments, for example, because in theory, in 50 years' time, they can replace them. We've got just a couple of minutes left, so I'm going to ask the last question, and then we can close this off. What's the biggest single development in your view that will boost the CDR market?
I think for me, it has to sit at kind of a large corporate, kind of board level. I think there has to be something that sits around large corporate saying this is a critical part of net zero transition thinking. Because where you see large corporates moving and therefore deciding to deploy resource, understanding, and supply chain, that's where it will have the biggest impact. Because everything has to come down from, in the same way we're seeing some of the biggest polluters, under the ETS, materially changing what they're doing. We need to see corporates move at the board level with an understanding of CDR. And, there's a number of ways of doing that, but that's where it needs to start.
Very good. And I guess a starting point is legislation, and another one is pressure from stakeholders, consumers and shareholders and so on. Very good. Hey, so I'm just going to say a very big thank you, Richard, for spending this hour with us, and indeed in the prep that we did a couple of days ago. Your presentation was fantastically illuminating. I hope that everyone in the audience found the same thing. I'm sure if they had their microphones on, they'd join me in a round of applause for you for your presentation and answering those questions so very well. So thank you very much indeed, and I will draw this webinar to a close. Thank you very much, Sylvia.
Thank you. My pleasure. Thank you for everyone's time.
Cheers, Richard. Bye.
Hi there, everyone. Good afternoon to those of us who are joining us in the Western Hemisphere.
Welcome to this webinar guide to corporate offsetting, and a big thank you to Net Zero Markets for hosting this for all.
You're no longer talking about a pure voluntary market, you're talking about a quasi-compliance market because it's captured under the accounting system of the Paris Agreement.
The advantages, of course, was that everyone became more familiar with the real potential of these market-based mechanisms like the CDM was at the time.
The idea is that the ICBCM will come out with a set of core carbon principles and an assessment framework of the different greenhouse gas crediting programs and determine, which ones pass the test and which ones don't.
Article 6 has been talked about for quite some time now, since 2015 in fact. When could that become a meaningful market? That might be one for you actually, David.
The short answer there is that yes, we do support it, but then there are different ways in which you would get recognised on our market.
Those bodies, I think they can really cover the entire globe.
There's a question from Parag about how do we know that purchase offsets have actually done their job in terms of avoidance or removal?
I took a gander at it, more so just because I think that what we're seeing in terms of the market price, we're back in some situations back to levels we were maybe a year or two ago.
And thank you all to the audience for engaging so much during the session. It has been really a pleasure to see there's so much interest in voluntary carbon markets.